We turn our attention now overseas to the currency markets. Quite a bit going on there. We had the Swiss franc hitting a record high at the beginning of the week. Well, Stephen Gallo is there waiting for us. He is from Schneider Foreign Exchange. He's the head of market analysis there. This is one of the Bloomberg best forecasters of currency exchange. Stephen, welcome to In the Loop. Let's start with the Swiss franc and talk last week, right, of the Swiss National Bank intervening to weaken that currency. What impact is that having on the rest of the European Union?
Well, I think overall the weakness that we saw at the back end of last week in the franc has to a large degree spilled over into the Monday trading session here in Europe, and it's coincided with a general rally or a relief rally, as it were, in risk assets. So the mood is somewhat better today than it was at the beginning of last week, and probably one of the indicators that has led that improvement has been the Swiss franc. In terms of the impact of the Swiss franc on the European Union, I think there are a number of important suggestions that the strength in the franc has for not only the global economy, but for Europe as well. Obviously, the extent of franc strength indicates the enormous degree of capital flows resulting from the sovereign debt distress that we know is occurring in the Eurozone, but also in other parts of the developed world as well. But I think even more importantly than that, the situation regarding Switzerland and its floating currency brings us home, back home, or back to the issue of what is the right monetary and currency arrangement for European economies. And I think that's still largely unanswered when you have so many different countries still with their own floating exchange rates, their own independent monetary policies. And then, of course, you have the euro area where many countries, when they joined the euro, surrendered their independent monetary policy and floating exchange rates. And so the question now we have with the Swiss talking about potentially pegging to the euro, or if they don't, they're left with the option of instituting some kind of capital controls. Or if they don't do that, they're left with the option of just keeping the floating exchange rate the way it is and dealing with the problems as they arise. What is the best option for Switzerland? I think that is an important question to be thinking about for the medium term. What should they do with their currency?
Let me ask you, Stephen, there's talk this morning of a euro bond of the European Union. Actually, instead of individual countries issuing their own debt, having a single unified bond. How would that change the currencies? How would that impact currency fluctuations?
Well, I think if we were to see, the Germans 100% behind the Eurobond, which we know currently that they're not, all the messages coming from Merkel's administration suggest that Germany is not 100% behind the idea of a Eurobond. But I think in terms of the currency reaction, I think you would see a large spike up in the euro if we were to see a development along those lines. But I think the spike would probably be temporary, because this is an option for the Europeans, but it's an option that needs to play out over a somewhat longer time period. It needs to be well thought out, and I think I turn your attention to the piece from Otmar Issing in the Financial Times last week. I think it was last Tuesday, and his comments suggest that if we are going to be moving towards a closer fiscal union in the euro area, it darn well better be the right type of fiscal union. So in other words, we don't want just a bailout union. We want a fiscal union with conditions so that countries are able to borrow off the stronger credit rating of other countries. Countries with weak credit ratings are able to borrow off, to a degree, stronger credit ratings, the stronger credit ratings of other countries, but they have to do so with strict conditionality. And until the Europeans actually put the framework in for that strict conditionality, macroeconomic governance, some type of Ministry of Finance for the euro area, the euro bonds are not going to solve the crisis. It's just going to lead to potentially more reckless spending.
All right, Stephen, we have to leave it there. Thank you for taking some time with us this morning. That was Stephen Gallo, head of market analysis at Schneider Foreign Exchange.